All right, happy Friday, everybody. You know, you're all ready for the weekend, and I'm standing between you and the weekend, but we got stuff to talk about. So really important, you may notice that Dr. Park has joined us today. Dr. Park, the reason he's here is that he's got his CMA, and he's actually expressed interest in going for his CPA. So we're going to cover everything that this course has been covered to date, and every other accounting course. We're going to talk about that in the next. I'm just joking. You can ignore Dr. Park. He's just here to take in the vibes and the vibes of three homework sets of 3 chapters of homework. Before we go through the homework review, though, I got some things that I want to remind you all of. So first of all, presentation groups have been assigned. I'm still waiting on topics for presentation, so please make sure that you reach out to me. Let me know what it is you want to present on. Also, November 8th, which is about 3 weeks away, your Excel assignment is due. I know that that seems still like a long time away, but please make sure that you start thinking about that sooner rather than later, and make sure that your data sets are all correct. And then, we got this thing coming up on Wednesday, exam number 2. Yeah, so that's something also that's on the schedule. As always, please make sure you complete the practice exam before you come into class on Monday so that we can review that and you already have knowledge of what it is we want to talk about. Study guide is also posted. Make sure you review the study guide and ask any questions. We'll do our standard review. I won't cover everything in the study guide, so if there's something specific that I do not cover that you have questions about, be sure to be ready to ask questions. With that, we got homework to go over, and I'm gonna have to close the door because is it Doctor? Who is it? Templeton class. This class just gets so enthusiastic.
You got 2?
What's that?
You got 2?
Oh, well, yeah. My students naturally get enthusiastic. I'm talking about auditing. Yeah, so yeah, here we go. All right, so we got 3 chapters to cover, so let's go ahead and get through the multiple choice first, and then we'll talk about the problems. So chapter 17, we started with question number 14. An auditor should request that an audited entity send a letter of inquiry to those attorneys who have been consulted concerning litigations, claims, or assessments. The primary reason is to provide what? So letter of audit inquiry, we talked about this, sending those to the lawyers. Remember, we can't trust the lawyers, okay? So if we ask them to give this specific information, if we're trying to obtain information, it will not work. Because who does the lawyer represent? Do they represent the auditor or do they represent the client? The client, yeah. So we want to make sure that we already have a pretty good idea of what it is we're looking for before we move into that. So going through the answers, you want the opinion of a specialist? No, we're not looking for their opinion. We're looking for information, confirmation of information. Description of litigations, claims, assessments that have a reasonable possibility of unfavorable outcome. Again, that's requesting information. They're not going to give that to us because they represent their client. Objective appraisal of management's policies and procedures adopted for identifying and evaluating legal matters. That word objective is pretty skewed, don't you think? Do you think the lawyer is going to be able to provide an objective assessment? Nope, they're going to provide a biased assessment because, again, they represent the client. So we have corroboration of information furnished by management concerning litigation, claims, and assessments. That word corroboration, that's just confirmation of the information that we already have. So corroboration is our answer. D is our answer there. All right, question 1715. An auditor issued an audit report that was dual dated for a subsequent event occurring after the date on which the auditor has obtained sufficient appropriate audit evidence, but before the issuance of the financial statements. Auditor's responsibility for events occurring subsequent to the date the auditor has obtained sufficient appropriate audit evidence was what? So we have 2 options. One option is that we can change the date of the audit report and we can take responsibility for everything as of that date. The second, or technically we covered this first, but the other option is dual dating, okay? Now, dual dating is, remember, we put 2 dates on there. We say we're going to issue the original date of the audit report, and then we're going to have a second date where we cover only the event that's referenced in the subsequent event. So we're just basically extending our liability, or sorry, not extending our liability. We're limiting our liability to that particular item. And that's the key. When you hear the term dual dating, you should think we're limiting our liability to the specific event reference. All right. So if that's the case, A is a pretty clear answer because it just basically says limited to the specific event referenced. All right, question 1721 was our final multiple choice question in chapter 17. Which of the following events occurring after the issuance of a set of financial statements in the company audit report would most likely cause the auditor to make further inquiries about the financial statements? So I know it's been a while since we talked about this. This was a week ago Monday, but remember the auditor was sitting on the beach after an audit, because that's what an auditor does. They hang out in Hawaii and get a phone call from the client and says, hey, there's something that should have been in the financial statements that you did not know about. All right. Do we have a responsibility for that information as auditors? Yes, we do. We absolutely have a responsibility for information. All right. So which of those best depiction of what we were talking about? So a technological development of the industry that could affect the entity's ability to continue as a going concern. That doesn't relate to the period under audit. That relates to something that will happen in the future. So that's none of our concern. So A is not our answer. The entity's sale of subsidiary that accounts for 30% of the entity's consolidated sales. That's a pretty important event, but again, it occurs after the audit, so it's not our concern. We're talking about only the period under audit that we're concerned about. I'm going to jump to D for no reason. The final resolution of a lawsuit explained in a separate paragraph of the auditor's report. Again, after the audit, so we're not concerned about it. Now, you may say B and D sure sound like subsequent events, and the answer is yes. If they occurred before the issuance of the financial statements, they would be subsequent events. But the question specifically says after the issuance of financial statements. So in this particular situation, they would not be subsequent events. So then we have the discovery information that regarding a tendency that existed before the financial statements were issued. Okay, if I had a bell, I would ding it here. Okay, that's where we'd say that we have a winner. So we have an event that or issue that existed before the balance sheet date that we did not know about, and we subsequently discovered it. That's where we would have to get up. We have to board our plane from Hawaii back to wherever our audit was and do our routines. Okay. And then we get to charge the client for that plane fare, and then hopefully charge the client for the plane fare back to Hawaii to finish our vacation. That's the goal. That's the dream. All right, moving on, chapter 18. Chapter 18, we start with 1812. An auditor includes a separate paragraph in an otherwise unqualified financial statement audit report to emphasize the entity being reported upon had significant transactions with related parties. The inclusion of this separate paragraph. So we talked about modified language. We talked about this on Monday. Remember, modified language takes two forms. We could actually modify the wording that's in the audit report, or we can add an additional paragraph called an explanatory paragraph. So this is referring to that latter situation, an explanatory paragraph. Now, what are the situations that we can add an explanatory paragraph? We said the report on internal controls over financial reporting. That was one that's pretty much always going to be there. We had that thing about concern about the entity's ability to sustain itself. What was that called again? Going concern, yes, going concern about the ability to maintain operations, okay, or going concern, substantially about the entity's ability to continue as a going concern. Then we had those things that we had the recollection from financial accounting, the lack of comparability, lack of consistency, all of those different issues. And then we had that fourth one, anything that requires additional emphasis, which I basically said could be anything else. So it was a rather unsatisfying conclusion because we basically said anything that's not captured by the first three could also be an explanatory paragraph. So basically anything on the planet could be an explanatory paragraph. Now we have to use judgment here, but do we think that a emphasis on significant transactions with related parties might fall within that fourth category? Additional emphasis? What do you guys think? Your judgment here. You got a professional judgment. I know professional judgment is difficult to it's difficult to utilize on a Friday afternoon in Violet Hall, but work with me here. What do you guys think? Professional judgment utilized here? Can we actually include that as a separate paragraph, an explanatory paragraph? I would say yes, that would be perfectly fine because we believe that this is information that might be valuable to users of the audit report. In that case, it is appropriate and would not negate the unqualified opinion because remember, explanatory paragraphs don't change our opinion. They just provide additional emphasis for us. All right. Question 1813, Eagle Company, a public company, had a computer failure and lost part of its financial data. As a result, the auditor was unable to obtain sufficient audit evidence regarding to Eagle's inventory account. What is that called, by the way, when we can't obtain sufficient evidence? What is that term for it? Scope something. Scope limitation, yeah, scope limitation. So scope limitation is what we're dealing with here. Assuming the inventory count is least material, the auditor would most likely either what? So in this question, and some of the questions we're going to talk about in a little bit, we're not asking what is the severity of the issue. I won't necessarily ask you for that. If it is, I will give you clear guidelines. In this question, it just says a scope limitation. It doesn't say, is it a material scope limitation or a pervasive scope limitation? That judgment's not there. So we have to select between two that would both represent scope limitations, but we're not necessarily concerned about what the severity is. So if it was a material scope limitation, what type of opinion will we issue? Qualified, okay. And if it's a pervasive scope limitation, we issue disclaimer, yes. So it's going to be either a qualified opinion or a disclaimer of opinion. So A is our answer. All right. Question number 16. King CPA was engaged to audit the financial statements of Chang Company, a private company, after its fiscal year had ended. King neither observed the inventory count nor confirmed receivables by direct communication with debtors. but was satisfied that both were fairly stated after applying appropriate alternative procedures. Now, we haven't really talked too much about alternative procedures. We'll get into a lot more detail on that when we get to the business process chapters. But this is basically saying we could not do one task, so we gained assurance by performing a different task. Okay. So it's a little bit like substituting ingredients in a recipe. As long as they taste the same, you're just fine with that. Okay. And the word appropriate is really important there. So if that's the case, what type of opinion are we going to issue? Well, we had initially a scope limitation because we couldn't perform certain tasks. Did we resolve the scope limitation in this scenario? Yes, we did. So we're going to say what? Clean opinion. What is another term for a clean opinion? Unmodified. Okay. Why did we use the term unmodified instead of unqualified? What's the key term or key piece of information in the question?
They're a private company.
Yeah, it's a private company. Remember, private companies are unmodified opinions. Public companies are unqualified opinions, but they're both mean clean opinion. Everything is fine. So we're good with that. We're going to say C. Okay. Probably don't need to do an emphasis of matter paragraph in this scenario. All right. Question number 19. Which of the following best describes the auditor's responsibility for other information included in the annual report that stockholders that contains financial statements in the auditor's report? Does everybody remember that picture of McDonald's annual report that I showed you? Remember? It was the Big Mac. It was the delicious Big Mac, the best looking Big Mac that had ever existed, one that I have never seen in reality. Okay. What did I say about the annual report? It's all sunshine and rainbows. It's trying to spin the best picture possible. So are we responsible for auditing that information? We are not. We are not responsible. We are responsible for auditing financial statement information. However, what if the annual report uses the information from the financial statements? Do we have to make sure it's consistently used in the annual report? Absolutely. That's basically what we're getting at right there. Since they're using information in the report, we have to make sure that we corroborate it, that we don't corroborate it, but we read it to make sure it's materially consistent. So the auditor has no obligation to corroborate the other information, but should read the other information to determine whether it's materially consistent with the financial statements. In other words, our client cannot use completely different financial statement information in the annual report. They have to use the information that is what they reported on in their annual report, that's 10K. Okay. So even though they want to put the best spin on it, if they lost $1 billion, they still have to do that. They can put it in different font colors if they like. Okay. They can put it in multiple colors to make it look good, but they can't report anything that's inconsistent. All right, moving on to chapter 21. Chapter 21, 16. Which of the following professional services would be considered to be an attestation engagement? So this is asking which of the type of services could we perform an engagement about? So let's just go ahead and review this real quick because we need to know this. 3 engagement types. One of them is very similar in detail to an audit. Okay, very high level of assurance. What was that one called? I'll give you a hint. You're about to take one here on next Wednesday. Examination, yes, examination, okay. Then we have the one that's kind of middle of review. It's kind of an audit light, okay. What did we call that? It's what we're going to do on Monday. We're going to review, yeah, that's right. We're going to do that. So like the way that I tied this back to the audit stuff that we're doing in this class. There we go. And then we had the one that's a really very low detailed audit. It's basically taking pieces of audit. It's like an audit buffet. We take and pick what we want. We don't necessarily want vegetables. We just want the cheeseburgers. That's the case. What do we call that one? Agreed upon procedures. Okay, agreed upon procedures. All right. Those are the engagement types. This is referring to the service types. We had 6 service types, and I'm not going to make you run through those. But remember, service type was also agreed upon procedures. Then we had prospective financial statements, pro forma financial statements, compliance, management's discussion analysis, and service organization controls reports. Okay, service organization reports. So all those types of services. So you're looking for one of those. The only one that's actually listed here is B. It says an engagement to report on compliance, because remember, that's one of our service types with statutory requirements. By the way, does anybody remember what type of engagement we can perform with compliance? Examination, because examination we can perform for all of them except for agreed upon procedures. And then as weird as it sounds, agreed upon procedures, we can also do those, okay? So either high end or low end, one of the two. Question 2117. An accountant may accept an engagement to apply agreed upon procedures to prospective financial statements, provided that what? This is talking about the type of engagement, okay? So the service is prospective financial statements, reviewing or looking at prospective financial statements, not reviewing, but evaluating. And they're applying agreed upon procedures, that's the engagement type. So let's review, okay? In generally speaking, what type of assurance is provided by agreed upon procedures? So high, medium, low, what do you guys think? It's variable in the scale, but what did I say is generally going to be the case? Low to none, okay? And then what does that mean about risk? Is the risk going to be high, medium, or low? If we don't provide any assurance, then risk is going to be high. That's high, Dr. Barnes. High. Yeah, there we go. Okay. All right. Do we provide a report or opinion in this particular scenario on agreed upon procedures? No report, no opinion. Or actually, we do provide a report, but it's just a summary of findings. So no opinion. All right. And then distribution was the big one. If we're doing agreed upon procedures, can we distribute that to a general audience? No, we cannot. It has to be restricted to a limited distribution. It has to be restricted in distribution. The reason we win all that is because if you go through all this, it says, like 2017. Sorry, my answer looks different here. So we have to actually note that examination is performed of the prospective financial statements. I'll go through each of the answers. Examination is performed of the financial statements. No. Okay. Examination is a different engagement type. Responsibility, adequacy, procedures performed is taken by the accountant. No, that's not something we have to specify. Negative assurance is expressed on prospective financial statements as a whole. We said no assurance was expressed. The engaging party acknowledges the appropriateness of procedures before the practitioner issues the report. That's our big one right there. Okay. That's the one we're looking at because we want to make sure that we're using appropriate procedures for our engagement type. So D is our answer. All right, let's, sorry, I think we have one more multiple choice question here. Yes, 2120. Which of the following statements is correct concerning both an engagement to compile and an engagement to review a non-public entity's financial statements? Okay, so let's just go through the list and let's talk about what the differences are. So the accountant is not required to obtain an understanding of internal control. Do we have to have an understanding of internal control for a compilation? No. Okay, do we have to have one for a review? No, we don't have to have them either. No controls whatsoever. Controls are out the book. Okay, that's my nightmare. No more controls. Okay, but we don't have to obtain understanding in either of these engagement types. So A is our answer, but let's go through the rest. Okay, the accountant must be independent in fact and appearance. Okay, does an accountant need to be independent in a compilation? No, accountant does not need to be independent. But what do they have to do if they're not independent? They have to disclose that fact. They have to provide an explanation in their reports. They have to actually say, we're not independent, but you should probably know this. We did perform the compilation, even though we're not independent. Are they required to be independent for a review? Absolutely, yes, 100%. Do need to be independent, required review. The accountant expresses no assurance on the financial statements. Does a compilation provide assurance? No, does not provide any assurance. Does a review provide assurance? Yes, it does. What's the type of assurance expressed in a review? So we had limited, or what was that called? Limited assurance, or not positive, but negative. Yes, negative assurance. Remember the difference, okay? Positive assurance says the financial statements are free from material misstatement. Negative assurance says the financials, we did not observe any material modifications. So instead of saying a positive statement, we make a negative statement. The accountant should perform inquiries and analytical procedures. That sounds like stuff we do during a review. Isn't that thing? Aren't those tasks that we perform during a review? Yes. Do we perform those same tasks during a compilation? No. We only perform those types of procedures during a review. So B, C, and D are not common between the two. The only one that's common between the two is A. And now I've lost my place. All right. We'll get there. We'll get there. All right. Going back to chapter 17. Okay. 1725. So for each of the following items, we're expressing an opinion on the financial statements and now preparing the opinions to come to financial statements, but then a subsequent event occurred. So the event was disclosed in the CPA, the connection with the review or subsequent event on or after the date that which the auditor obtains sufficient appropriate evidence. Describe the financial statement effects, if any, of the subsequent events. Each of the 5 items is independent with the other 4 and considered separately. So the explanation of this is actually not very good, because not all of these actually constitute subsequent events. They said they're constitute for consideration of subsequent events, but some of these are not actually subsequent events. So here's what we're going to do. I'm going to ask you guys 3 questions, okay? And you're going to boisterously respond in response to my questions, okay? My questions are going to be, is this a subsequent event? Yes or no? If it is a subsequent event, what type? Remember, we had type 1 or type 2. If it's type 1 or type 2, then we're going to talk about what is the treatment for that, okay? So a large accounts receivable from a agronomist company, material to the financial statement presentation, was considered fully collectible at December 31st, 2021, but they suffered a plant explosion on January 25th, 2022. Because agronomist was uninsured, it's unlikely the account will be paid. What do you guys think? Is this a subsequent event? This is clearly a subsequent event, okay? Type 1 or type 2? So type 1, we basically say that the situation or the circumstances existed at the balance sheet date. So the plant explosion take place before or after the balance sheet date? After, okay, so it's after the balance sheet date, so it has to be type 2. The circumstances did not exist at the balance sheet date. So type 2, if that's the case, what do we have to do? Well, minimum, we have to disclose the situation of the financial statements, or more appropriately, our client has to disclose the situation of the financial statement. Additionally, could they actually prepare pro forma financial statements? Yeah, if it's a significant enough receivable that it might affect their operations, they may have to prepare those. Okay. Question 2, tax court ruled in favor of the company on January 25th, 2022. Litigation involved deductions claimed on the 2018-2019 tax returns and accrued taxes payable. Skornick had provided the full amount of potential disallowances. The IRS will not appeal the taxes ruling. So here's what happened. We had a litigation. We had a lawsuit. They had actually accounted for a liability because it was a contingent liability. They had accounted for the full amount of the potential liability. And then after the balance sheet date, court came back and said, you know what? You were right all along. We're going to rule in your favor. So do they have to pay that liability anymore? No. Okay. No, they won the lawsuit, which is great. Okay. No more liability. What type of, or sorry, is this a subsequent event? I kind of spoiled it already, but is this a subsequent event? Yes, it is. Okay. What type is it? Okay. Type 1 or type 2? It's type 1. Condition did exist at the balance sheet date. That was our example of type 1 that we talked about, the most common example. So how are we going to do this? Type 1 subsequent event is always treated how? We have to go back and restate the financial statements, go back and restate those financials, which makes sense because we won in this situation. So we want to make sure that we don't have that liability on there anymore because we're not going to have to pay that liability. Skornick's manufacturing division, whose asset constitute 45% of Skornick's total assets on December 31st, 2021, was sold on February 1st, 2022. The new order ascended the bonded indebtedness associated with this property. So they sold off 45% of their company. What do you guys think? Is that a subsequent event? That's a pretty significant subsequent event, I would say. Yeah, pretty significant. Half your company gets sold. Okay. All right. Type 1 or type 2? Type 2, condition did not occur until February 2022. So if that's the case, disclosure and probably pro forma financial statements because we're getting rid of half of our company here. All right. January 15th, 2022, Ari Fogler, a major investment advisor, issued a negative report on Skornick's long-term prospects. The market price of Skornick's common stock subsequently declined by 40%. Oh no, that's pretty bad news. Is this a subsequent event? Does this have any effect on the balance or on the financial statements either previously or in the future? Has no effect whatsoever on the financial statements. This is an external market valuation, okay? This is not a subsequent event, not a subsequent event. Okay. January 5th, 2022 meeting, Skornick's board of directors voted to increase substantially the advertising budget for the coming year and authorized a change in advertising agencies. This is an interesting one. Is this a subsequent event? I don't know. I haven't read many disclosures say, okay, we're going to start paying our advertisers more. Doesn't seem like a big one. It doesn't seem like it substantially increased our advertising budget. Yeah, this does not seem like a subsequent event to me. Yeah, so 4 and 5, not subsequent events. We can move on with our lives. So you try to keep things simple as possible. Simple as possible. That's the goal here. All right, moving on. Heard you guys like audit reports. So we're going to talk about audit opinions. All right. Oops. I think I went a little bit too fast. I was so excited. For each of the following independent situations, indicate the type of financial statement audit report that you would issue and briefly explain your reasoning. Assume that each is at least material. All right. So Bearfield Corporation, the wholly owned subsidiary of Sandy Incorporated, is audited by another CPA firm. As the auditor of Sandy Incorporated, you have assured yourself that the other CPA's firm's independence and professional reputation. However, you're unwilling to take complete responsibility for the audit work. All right. So before we talk about any addendums, what opinion is issued here? So assuming that we're talking about at face value before any of modifications, this is an unqualified opinion. Okay. Is this still an unqualified opinion? Yeah, this has no effect on the financial statement presentation or analysis. Okay. No opinion, no effect on that. However, can we add explanatory language here? Yes. What type of explanatory language will we use here? Probably modified wording, because this is the one example of modified wording we talked about. and probably an additional paragraph if it's a public company. Okay. So unqualified opinion with modified wording. Management of Bonner Corporation has decided to exclude the statement of cash flows from its financial statements because it believes that bankers do not find the statement to be very useful. Okay, that's their judgment call. By the way, is the statement of cash flows required by GAAP? Yes, Dr. Barnes. Yes, it is. It's wholly required. Is it required by GAAP? Yes, it is. It's required under generally accepted accounting principles. So this is a departure from GAAP. All right. So what type of opinion are we issuing? So we got two possible opinions. If we don't think it's an extreme situation, if it's just material, what are we going to issue? Nope. So disclaimer opinions for scope limitation. So it's not extreme. Qualified. Or if we think it's a pervasive situation, what is it going to issue? Adverse. Okay. So qualified or adverse. Statement of cash flows exclusion, I would probably think on adverse on that one. That being said, it kind of pales in comparison to our next example. You audited Diverse Carbon, a manufacturer of nerve gas from the military on the year September 30th to September 1st. One of its manufacturing plants caught fire, releasing nerve gas to the surrounding area. This is dark. 2,000 people were killed and numerous other paralyzed. The company's legal counsel indicates the company is liable and the amount of liability can be reasonably estimated, but the company refuses to disclose this information in the financial statements. Do we think that there's a contingent liability present here? What do you guys think? We're wholly responsible for the deaths of 2,000 people, which again, is only a scenario that we can even consider in the classroom, okay? So there's probably a contingent liability and they refuse to disclose this contingent liability. Is that a violation of GAAP? Yes, and what do we just say? Departure from GAAP is going to be qualified opinion or an adverse opinion. In this situation, I would lean probably towards the adverse opinion. This seems pretty extreme. During your audit of Kuchia Coal Company, the controller, Tracy Tricks, refuses you to allow you to confirm accounts receivable because she is concerned about complaints from her customers. Well, that's understandable. You are unable to satisfy yourself about accounts receivable by other audit procedures, and you're concerned about Tracy's true motives. The alliteration in that question is so ridiculous, okay? Letters C and T all over the place, I'm telling you. All right, that's really hard when you're reading them aloud. All right, so what do we call this, by the way, when we can't do our job? Scope limitation, okay? Scope limitation. Is this a scope limitation? Yes, it is, okay? So what's our options here? If we think it's only a material scope limitation, it's going to be qualified. If we think that it's a pervasive scope limitation, it's going to be disclaimer of opinion, okay? So probably one of those two. Do you think that probably we should also tell the audit committee about Tracy's true motives? That would be a great romance novel, Tracy's True Motives. Yeah. Okay. By the way, if anybody who writes that, you're gonna have to give me credit for it in the forward. Okay, the acknowledgments. All right. January 31st. Sorry, toy manufacturer hired your firm to audit company's financial statements for the prior year. You were unable to observe the client's inventory on December 31st. However, you were able to satisfy yourself about the inventory balance by using other audit procedures. So we did have a scope limitation, but we managed to work around it. Okay. So what do you guys think? What's our opinion here? It's a clean opinion, so we're going to call it unqualified. Yeah, I'm happy with this. Okay. I would be fine with this if I was doing auditing in the real world. Gelato Brothers Incorporated leases a manufacturing facility from a partnership controlled by the CEO and the major shareholder of Gelato. Your review of the lease indicates that rental terms are in excess of rental terms for similar buildings in this area. What is this called, by the way? What are we referring to here? Sounds like a related party transaction to me. We got a related party situation. Company refuses to disclose this related party transaction in the notes of the financial statements. It was about to tell us that. It was about to tell us it was a related party transaction. So audit responsibility for related party transaction. We have to make sure the client does what? They have to disclose related party transactions in their financial statements, but this company refuses to do so. Is that a violation of GAAP? Okay, we've already dealt with a couple of violations of GAAP already, so it's either a qualified opinion or an adverse opinion, depending on how severe it is. And also unfair that other properties have to have such a bad beat when this other property is getting preferential treatment. Okay, I guess that's the advantage of related party transactions. Johnstone Manufacturing Company has used the double declining balance method to depreciate its machinery. During the current year, management switched to the straight line method because it felt to better represent the utilization of the assets. You concur with this decision. All information is adequately disclosed in the financial statements. All right. What do you guys think? Is this going to affect our opinion at all? Not at all, okay? Because we're saying right here, there's nothing that's changed in the financial statements. All they're doing is they're using one method and changing to another, and we think that's fine. We think that's appropriate in the situation. However, so unqualified opinion, can we agree with that? However, would this possibly affect comparability? So one period we're using the double declining balance, another period they're using the straight line depreciation balance. It looks like their depreciation amounts are going to be different from period to period. Is that something the stakeholders will want to know about? Yes. So we might include an explanatory paragraph to disclose that information. Yes. It's not necessarily required because remember, change in accounting principle doesn't, I guess, change in accounting principle, this would be a change in accounting principle. So it would be required. My apologies. I was thinking of change in accounting estimate. So yeah, explanatory paragraph. All right. That was a lot of fun. That was a lot of fun. Want to do some more? It's too bad. We're going to do some more. All right. Abadi Mines Incorporated uses LIFO for valuing inventories held in the United States and FIFO for inventories produced in its held in its foreign operations. Is it legal to use LIFO domestically and FIFO abroad? What do you guys think? Did you do some research on this? Did you go back and Google? It says LIFO, international accounting. What do you guys think? First of all, is LIFO even legal internationally? Does anybody know the answer to that question? Does anybody know what LIFO is? Okay, FIFO, LIFO, they sound like good dog names. In fact, I think Dr. Keaton's dog is actually named FIFO. Okay, FIFO, LIFO, first in, first out, last in, first out. Okay, okay, last in, first out is not legal to be used in international accounting. IFRS standards do not permit that. Okay, so this is one of those rare exceptions where we can use LIFO domestically and FIFO internationally because we can't use LIFO internationally. So this would be fine. This would be an unqualified opinion. Which again, I don't expect you to actually know that, but it's kind of interesting discussion to have, okay? Walker Computers is suing your client, Super Software, for royalties over patent infringement. Super Software's outside legal counsel assures you, and you agree, that Walker's case is completely without merit. Super Software does not disclose any contingency related to this case. So contingent liability disclosure, the requirements has to be probable and reasonably estimable, okay? Is it probable that anything's going to happen? Is it even remotely possible? No, it looks like that there's not going to be anything that comes across of this because it's just a remote situation. The lawyer says this is a scam, this is a setup. They're not going to actually get anything out of us. So there's no contingency required. So did they violate GAAP in the situation by not recording the contingency? They did not. They did everything fine. So we're going to issue an unsomething opinion. Unsomething opinion. Unreal opinion, Dr. Barnes. Unmitigated opinion. It's an unmitigated disaster. And then what, guys? I know it's Friday afternoon, but you got to work with me here. Unqualified, yes, unqualified. Say it now, say it loud. All right. In prior years, Worcester wool mills used current market prices to value its inventory of raw wool. During the current year, Worcester changed to FIFO for valuing raw wool. It's interesting. Current market prices, is that something that's a GAAP approved method for inventory? Did you study that back in 220 and 221 and say, oh, current market price, we're making adjustments for GAAP to that or for inventory of that? Is current market price a legal method of inventory evaluation? It is not. It is not a legal method. So we're changing from an illegal method to a legal method. You as the auditor, do you approve of that or you disapprove of that? So the auditor, I'm kind of like, cool job. Yeah, good job. You're doing a good job. So it's going to be an unqualified opinion because they're actually getting back in line with what they should be doing. But should I provide some explanation for that? This will affect comparability. So I want to make sure that I've got a disclosure in my report. So I'm going to add an explanatory paragraph. Upon review of the recent history of lives of specialized service truck, Gas Leak Technology, what a great name, justifiably changed the service lives for depreciation purposes on its truck from 5 years to 3 years. This change resulted in a material amount of additional depreciation expense. Okay, so they justifiably made the change, so are we cool with that? Is there a violation of GAAP here, I guess is the question. Can companies change the service life of their equipment? Yes or no? You don't even have to yell it out loud. You can just nod your head or shake your head one way or the other. You can go like this if you really want to, if you're not certain. Okay. Answer is yes. Okay, that's fine. Okay, that is allowed. Okay. In fact, this is one that we would treat going forward. It's a prospective change according to generally accepted accounting principles. That being said, it's a material change. So is that likely to have a comparability effect between periods? Yes. And this is probably a situation where we'd say, even though we're not required to issue an explanatory paragraph in our audit report, we probably will include one just for purposes of those purposes. That last sentence kind of gives you a hint on that, saying the material amount of additional depreciation expense. We probably want our users would probably want to know why is there a material amount difference. During the audit of Kwame Bakery equipment, you found that a material amount of inventory had been excluded from the company's financial statements. After discussing the problem with management, You become convinced that it was an unintentional oversight. Management appropriately corrected the error prior to your finalization of field work. So you're doing your audits, you say, hey, what's this over here? It says, oh my gosh, we forgot to tell you about that. So sorry about that. We didn't mean to. And you're just like, you know what, these are good people. We know that they were trying to be honest. They just admittedly oversight. So are you okay with that as an auditor? If you believe it was an unintentional oversight? It says, no, lawsuit. No, okay. So they made a mistake. They corrected the mistake. We managed to get it resolved inside field work. So we're going to issue unqualified opinion. Everybody agree with that? All right. Then Jay Rich holds CPA, or TPA holds 10% of the stock in Rothenberg Construction Company. The board of directors of Rothenberg asked Rich to conduct its audit. Rich completes the audit, determines the financial statements present fairly in accordance with generally accepted accounting principles. Well, that's good. So financial statements present fairly. So we got an unqualified opinion here, right? Is there anything suspicious here? Anything a little bit sus? Okay. You're Gen X, Dr. Bart. You can't use that word. Yeah. Okay. All right. So what's suspicious here? Then he owns 10% of the stock. There is an independence issue here. There's an independence problem here. We talked about this very, very briefly back when we talked about this in chapter 18 and chapter 1. If you're independent, can you issue an opinion on financial statements in an audit? No, you're required to be independent. So in this situation, he cannot issue an opinion. Thus, he has to issue a disclaimer of opinion. A disclaimer of opinion would be the appropriate response here. Okay. Jay cannot issue an opinion because he's not independent. Ramamu 3, savings and loans financial condition has been deteriorating for the last 5 years. Most of its problems result from loans made to real estate developers in St. Johns County. Your review of the loan portfolio indicates there should be a major increase in the loan loss reserve. Based on your calculations, the proposed write-down of loans will put Ramamu 3 in violation of the state's capital requirements. The client refuses to make an adjustment or to disclose the possible going concern issue in the notes to financial statements. Well, we've got a lot to go on here. So first of all, okay, there's basically they're making an estimate on their loan loss reserve, and you as the auditor think, you know what, this is nowhere close to being where it needs to be. If they made that estimate, they made that appropriate estimate, they'd be in violation of their covenants. Okay, remember we talked about covenants earlier in the semester. Those are requirements that you have to meet for certain contractual obligations. So they're basically in a damned if you do, damned if you don't scenario. Okay. Plus, it looks like their operations are going so bad that there's substantial doubt about their ability to continue as a going concern, which they failed to disclose. So let me just ask a simple question. In this scenario, are there one or more violations of generally accepted accounting principles? At least one. Okay. Probably multiple. Okay. Probably multiple. In fact, there are multiple. The loan loss reserve write down is a violation, or the amount that we're not recording. And then their failure to record the substantial doubt about the inability of going concern, that's also a gap violation. Now, certainly problematic. We would say that there's material misstatements here as a result of this, and we probably issue, if it's material but not pervasive, we issue a qualified opinion. It's pervasive, we issue a adverse opinion. I'm leaning more towards adverse opinion. This seems like a really, really big problem here, a real big series of issues here with this particular company. All right. Oh, also, I did forget, okay? Is there anything else we might want to include in this particular scenario? So we're already on adverse opinion. Can we all agree on that? Adverse opinion, qualified opinion. Is there anything else we might want to include there? So when we have a going concern issue, do we have as a responsibility of auditors to disclose that in some way? Yes. If there's substantial doubt about the entity's ability to continue as a going concern, regardless of whether the client discloses that information in the financial statements, we have to include an explanatory paragraph in our report that states there is substantial doubt about the entity's ability to continue as a going concern. So in addition to saying, yeah, this client is doing terrible, terrible things and we want you to know about it, we also say, oh, and also they won't be in business in a year from now, so may not want to invest in this client. Or if it's GameStop, you want to invest right now. You know, it depends on what it is. Okay. Depends on your scenario. Depends on your appetite for risk, I suppose. All right. Let's go ahead and move on to chapter 21. Orange Grove Farms has approached your CPA firm with some questions. Orange Grove's management has spoken with a bank about obtaining a loan to expand its operations. The bank has informed Orange Grove that the bank will not make the requested loan unless the company submits financial statements. Further, the interest rate of the loan will depend on whether Orange Grove's financial statements are compiled, reviewed, or audited by an independent auditor. Orange Grove's management is not familiar with the differences between these three services and wonders why the interest rate charged on the loan would depend on the service they obtained from your CPA firm. Well, this is an interesting question. This is one that I gave you because I wanted you to kind of do some speculation analysis. So let's talk about the things we know, and then let's talk about the things we don't know, shall we? What's a compilation? We know that. So a compilation is basically where we prepare financial statements for a client based on management representations. Okay. How does this differ for a preparation? Remember, preparation is in accordance with a specified framework, whether that be generally accepted accounting principles or some other specified reporting framework. We talk about a compilation. A compilation is based on a specified reporting framework, but also the estimates and judgments made by management. We don't make those judgments ourselves as the accountant. We ask the management to do that. Okay. But more importantly, what type of opinion is being introduced in a compilation? What do you guys think? Is there an opinion being introduced in a compilation? No. We issue a report, but we don't issue an opinion. Okay. If there's no opinion being rendered, is there any assurance being provided? No, because remember, opinion and assurance were those things that we tied together on Wednesday. We said, if there's no opinion, there's no assurance. Okay. So zero assurance in a compilation. Bear with me, we'll get back to that. All right. A review, okay? Review of financial statements, we basically say that a review is a limited scope procedure to provide some assurance, okay? Do we provide an opinion in a review? We do, but what do we call it? We don't call it an opinion, we call it something else. Begins with the letter C, and it rhymes with conclusion. Conclusion, yes, there we go. Okay, we issue a conclusion rather than opinion. What's the difference? The words are different, okay? The words are different, but they both mean the same thing. We're providing opinion. What type of opinion are we issuing, or what type of assurance are we providing in a review? It's not nearly as stringent as an audit, okay? We said it was limited assurance, or what is that term that we said for limited assurance again? Negative assurance, okay? Negative assurance. The financials, we did not believe that there's any material modifications, okay? Not observe any material modifications. So a negative statement. So this is kind of in the middle, all right? This is in the middle. Some assurance. Not a whole lot of assurance, but some assurance, all right? Then we move on to an audit, okay? Audit provides what level of assurance? And you got to get this one because this one's a core foundation of this course. Reasonable assurance. Why not absolute assurance? Absolute assurance is possible. So we have the highest level is reasonable assurance, 90 to 95% assurance, okay? We have a positive statement. We definitely issue an opinion. The opinion is straightforward. The opinion is always going to be the financial statements are free from material misstatement. I say that's if we have an unqualified opinion. Now, if we have different types of opinions, then we'll issue different reports. But for the most part, if we're talking about an unqualified opinion, it's always making that strong positive statement saying, yeah, there are no material misstatements. We're reasonably certain about that. 90 to 95%, okay? Which is good value, good odds on that one. All right. So let's say that you're trying to make a judgment, okay? You've got a choice. You've got three clients that are identical in nature, okay? You've got three clients that are identical in nature, and you're trying to make a judgment about which is going to be the riskiest client. So one has got an accountant that's saying, well, I compiled the financial statements. I can't tell you anything about the nature of their organization other than those financials. Another one says, we did a review. We did some things. We inquired with the client. We performed some analytical procedures. We know a little bit about them, not as much as we'd like to. And then we got the external auditor, and the external auditor says, we know everything about this client. We spent 90 to 95% of our time just doing nothing but evaluating this client. We're very, very certain about the situation here. Which are you going to have place most faith in? Probably you're going to put the most faith in in the audit, okay? Let's not face an audit. And least faith in the compilation. Now, let's go back to some concepts that you learned in your finance classes, okay? Let's say you've got these three identical companies, okay? One with the compilation, one with the review, and one with the audit, okay? Which one are you going to categorize as the most risky? The one with no assurance? Yeah, the one with you have no assurance on, it's like, okay, here are the financial statements. I have no idea if they're correct. Now, technically speaking, you could kind of call me out here. You could say, Dr. Barnes, they're identical companies, and one of them was audited. So if they're identical, I know what all three are. All right, ignoring that, okay, that we've got three companies that have got different levels of assurance. The lowest level of assurance is going to be the highest level of risk. Does that make sense? And the highest level of assurance would be the lowest level of risk. Now, what do we know about the relationship between risk and return? If you have high risk, do you require a high return? Yes, okay. Would a bank actually consider things that way? If they considered an investment to be risky, they would basically require higher interest rates on the loan. Okay. So let's think about these relatively speaking. Let's say I've got three interest rates. I've got a 10% interest rate, I've got a 6% interest rate, and I've got a 2% interest rate. Which one's most likely to receive that highest 10% interest rate? Is it going to be the compilation, the review, or the audit? Compilation, okay? There's a high level of risk. We have no certainty about the information that's in the financial statements. So because of that risk, the bank is going to say, look, there's a possibility you're going to default on this loan. We're going to make you have this high level of interest. Conversely, they give this full financial statement audit. They say, wow, we are so happy with this. We're going to give you the greatest loan ever, 2%, okay? Which is better than you get on a mortgage on a house, okay? Actually, it's a lot better to get a mortgage on a house right now. But yeah, good 2% loan. And then right in the middle is that review. Some uncertainty, but a little bit of assurance, okay? Some risk, but not nearly as much risk as the case of the compilation. So in this situation, they were talking to the person that's saying, all right, you're looking for this loan, you probably want to go with which engagement if you want the lowest interest rate. This guy still the CPA, or sorry, who was the individual? Management, Orange Groves Management. It doesn't say an individual, it says Orange Groves Management. So apparently the management of this company has no idea about how risk and return works, but they don't know the difference between these three types. So you're trying to advise them, you say, all right, if you want the lowest interest rate, we advise you to get a compilation, review, or audit. Audit, okay? Will it cost a little bit more? Yes, it's a more strenuous engagement, but it will actually reduce the return or the interest rate that you have to pay in the future. All right. Everybody got that? Okay, everybody ready to start their weekend? All right, we'll be back on Monday for the exam review. Again, please make sure you review the study guide. Please make sure you complete the practice exam before you come in. Have a wonderful weekend.